The billionaires are exiting the system, the very same one that is at all-time highs. Why is that? Why is nobody talking about this? What does it all mean? And most importantly, what does it tell us about how we should position? Let's examine. The stock market is at all-time highs. The headlines say everything is fine. Buy more. $1 trillion IPOs. Get rich now. Artificial intelligence is minting trillion-dollar companies. Retirement accounts are rising. Financial television is celebrating. I dare say they're dancing. And yet, some of the people who built this system and who are benefiting the most from it appear to be heading for the exits. Over the past several years, high-profile insiders like Jeff Bezos, Jamie Dimon, and Mark Zuckerberg have sold billions of dollars worth of stock. Now, let's be fair. Executives sell shares for many reasons: diversification, taxes, estate planning, just to name a few. But here's the question nobody asks. What are they buying with the proceeds? Because if you spent your life accumulating paper wealth and then suddenly you start converting part of it into tangible assets, that tells us something. Maybe not what is coming, but certainly what they're worried about. And that brings us to one of the most important concepts in finance: counterparty risk. Most people have never heard this term. The wealthy think about it constantly. Counterparty risk is simple. What happens if the person on the other side of the promise cannot deliver? Your stock is a claim. Your bond is a claim. Your pension is a claim. Even your bank account is a claim. In fact, when you deposit money into the bank, you're essentially lending it to the bank. The institution owes you the money back, and normally that's not a problem, right up until it becomes one. History is filled with institutions that looked invincible right before they weren't. Now combine that reality with an increasing digital world. Digital money, digital assets, digital records. Convenient, right? Well, maybe. But digital wealth is also dependent on systems, institutions, and permissions. Which raises a simple question: how much of your wealth exists only as an IOU? Because an IOU is only as good as the institution standing behind it. And that's why some investors appear to be moving towards what I call the 3 pillars of the great wealth exit. The first pillar is productive land. Watch what wealthy investors buy when they already have more money than they can spend. Farmland, timberland, ranches, water rights. Why? Because productive land creates value regardless of what happens to the currency. It grows food, it produces resources, it generates incomes, and for thousands of years, governments have come and gone. Productive land has remained productive. The second pillar is physical silver. This is where things get controversial. There are effectively 2 silver markets: the paper market and the physical market. The paper market consists of ETFs, contracts, and financial instruments tied to silver prices. The physical market consists of actual metal, bars, coins, industrial inventory. Many precious metal investors believe there are far more paper claims than immediately available physical ounces. Critics disagree, but regardless of where you stand, the distinction matters. One is an asset, the other is a claim on an asset. And throughout history, uncertainty tends to increase demand for things people can physically possess. Which brings us now to the third pillar: sovereign infrastructure. The media calls them billionaire bunkers. I think they're missing the point. Private energy, private water, private security, backup communications, independent systems. This isn't necessarily about predicting disaster. It's about resilience. Corporations build redundancy into data centers. Airlines build redundancy into aircraft. Billionaires redundancy into their lifestyle. Resilience is not necessarily paranoia. It's risk management. And when you put these 3 pillars together, a pattern emerges: land, physical assets, independent infrastructure. Notice what's missing? More leverage, more promises, more paper. Now, let's talk about the timeline. Many macro investors have become increasingly focused on the 2026 period because of debt levels, fiscal deficits, refinancing needs, and broader monetary uncertainty. Nobody knows exactly what happens next, myself included. Anyone claiming certainty is selling something. But there is a signal worth watching. Watch the relationship between paper claims and physical assets. Watch what institutions accumulate. Watch what wealthy insiders actually do with their money. Actions are expensive. Narratives are cheap. And the good news? You don't need $1 billion to think like a billionaire. You don't need a ranch in Montana. You don't need a private island. You don't need a bunker. The lesson is not to copy the wealthy. The lesson is to understand the principles. Reduce dependence on promises. Increase ownership on tangible things. That might mean physical precious metals. That might mean productive property. That might mean useful skills. That might mean reducing debt. The exact strategy is yours to decide, but the principle remains the same. Own more, owe less, trust fewer IOUs. Because there is one question every investor should ask themselves. If the screen goes black tomorrow, what do you actually own? Not that your brokerage statement says, not what an app says. What do you actually physically own? That question may define your next decade. So let me know in the comments, what is your exit asset? Stay ahead of the curve, because now you know the rest of the story for why billionaires are exiting the system and now, and how you yourself can position. So build that stack. iBankerU. Good day.